So let's move into the beginner and entry and exit signals. We're going to talk about the chart setup that you need to place these trades. Understand that your analysis is going to be done across multiple time frames. You're going to do what I call top-down analysis, which means you're going to start on the daily time frame and work your way down to the 4-hour and then the 1-hour. The entry is going to be taken on the 5-minute chart, which means that these are day trades. These are not trades you're looking to hold over the long term for multiple days. You're going to look to get in, be instantly in profit or very quickly in profit, and then get out of the trade in profit as well. The only indicators that we're using here with this strategy is the 8 and 21 EMAs. We're going to go back and use those candle formations that we spoke about earlier, the 2-candle, 3-candle reversals, and the shift candles. But the only indicators, technical indicators that we're going to use are the 8 and 21 EMAs. And that's what keeps this very simple. The lack of complicating your charts with indicators keeps this strategy simple. And when, like I said, when we move into the next chapter, we're going to add indicators and make it a little bit more detailed. But before we get there, let's talk about the risk management that you need with this beginner system. So for your stop loss, when you're short, understand that you want it to be above the most recent lower high. And when you're long, you want it to be above the most recent higher low, which means in a downtrend, you know that market structure will make lower highs. When you find your short entry, and I'm going to show you this on the chart markups, the stop for these entries is going to go at that most recent lower high in the downtrend. When you're long, your stop is going to go right at that most recent higher low because, again, in an uptrend, you're making higher lows as it continues up. So that's where your stop loss is going to be. It doesn't change. The take profit is always going to be at first 2R, 2 to 1, which means if the stop loss at that most recent, let's say we're short, if the stop loss at the most recent lower high is 10 pips away, we're going to try to get 20. If we can go get 20 out of this trade, that's going to be a trade that we want to potentially be involved in. That 2R take profit, you should be able to measure beforehand and understand, yes, this trade has the potential to go 2 to 1. No, this doesn't, so I'm going to stay off of this. I'm going to find a better trade. And on top of that, when we talk about your risk per trade, a lot of people ask me about this. Understand that with this beginner strategy, you don't want to risk more than 1% per trade. If you're using this system, as you get better with it, of course, you control the percentage of your account that you risk. I'm never going to, whip you and tell you that you have to do a certain percentage. But to keep it safe, if you're using this beginner system, less than 1% or no more than 1% is the perfect amount of risk because there will be situations if you happen to get in a choppy market where you do need to quickly get out of the trade for a small stop, maybe 4 or 5 pips, and then get back in when it represents. And you don't want to be risking 4 or 5% to get chopped around like that. So with this strategy, you want to be at 1% of equity or less. Now, the entry and exit signals. Understand that, like I mentioned before, we're going to do top-down analysis, starting at the daily, then moving to the 4-hour and the 1-hour. The entry signal, long and short, is described as when the 5-minute 8 and 21 EMAs cross with an entry candle off the 21 EMA. We can take that a little bit deeper and say if we are already in that 5-minute upshift or downshift, if we're long or short, you can also trade that 2-candle or 3-candle reversal formation if it's coming off the 21 as a potential entry signal here. The exit is going to be when 2R is reached, or if you get a break of the 8 EMA, that yellow line. That's going to always be your safest exit. So let's say it drops for you 5 pips, but then turns around and breaks. You can pull that trade and take the small profit and just come back for the next one. Now, some people like to be a little bit more risky. Some people like to be a little bit more aggressive and hold their trades, hold their conviction. And I like that. That's actually how I tend to be sometimes. So the hard and fast exit rule where you need to be out of the trade if you haven't reached take profit is when a candle with a strong bar or 2 or more candles breaks the 21 EMA. So the 8 EMA is going to be your buffer. That's your safe exit. That's starting to tell you, okay, we broke the 8, trend might be slowing down. But it could break the 8, go slightly back a little to the 21, and then continue back in the overall trend. So the super last resort exit is when it breaks the 21 EMA with either, like I said, a strong bar, a big bar through that 21, or 2 small bars or more. If it only breaks the 21 with 1 candle and it's not a strong bar, you might see it quickly come back down under the 21, so you don't want to just jump out. Now, I know these exit signals are a little bit vague in the sense that you can choose between which one you want to do. The best thing to do is always be safe if you're just starting out. Once you build comfortability with the strategy, you can adjust and then say, okay, you know what? I'm not getting out of trades when they break the 8. I'm going to hold them a little bit longer, and I'm going to wait to see if they break the 21. That's when I'm going to get out. And the thing that I like to do best, and when we talk about the checklist in the next couple slides here, The thing that I like to do best is determine it before I even take the trade. If I'm like, look, I really like this, all the time frames are great, I think this is going to keep dropping, I want to hold the short, even if it breaks the 8, I'm holding it. Build that into your mindset when you write down your entry before you actually take the trade. That way, if it does happen, you're not emotional, you're not reacting in the moment, you're reacting based on what your plan told you to do. So let's talk about the steps that go into taking this trade. First, you're going to identify the daily trend on the daily time frame. Then work your way down to the 4-hour time frame. See if that 4-hour trend confirms the direction that the daily trend is telling you. Then do the same thing on the 1 hour. If all 3 of those trends are telling you the same thing, and I'm going to show you how to read that in a second. If all 3 of those are telling you the same thing, you take it to the 5-minute and you wait for the entry signal, whether it's the 8 and 21 cross or one of those candle formations, off the 21 EMA to take the entry in the direction that the daily, 4-hour, and 1 hour were telling you. So it's pretty simple. It's top down and then enter on the 5-minute. Got it? Now, when we talk about a checklist, you can write this down, you can screenshot this, it might help you. You're going to ask yourself, which direction is the daily telling us? Which direction is the 4-hour? And which direction is the 1 hour telling us to trade? If you want to be even more specific, check out the 15-minute chart before you touch the 5-minute. You want as many of these time frames to confirm the direction, either long or short for you, before you take the entry. Let's say, for example, only 2 of them confirm that direction. You're going to want to maybe go look for a better pair, a more trending pair. You're not going to want to do something if the daily is the only one telling you short, but the 1 hour and 4 hour are telling you long. You're not going to find a great trade there. But if the daily, 4 hour, and 1 hour are all telling you short, entering on the 5-minute short is the right move. Now, you want to also ask yourself, what direction was the most recent cross of the 8 and 21 EMAs? Are you in an upshift, in an uptrend on the higher time frames? Okay, good. Then we want to look to potentially find an entry going long here, right? You want to also ask yourself, is the entry candle off the 21 EMA? And is the entry candle maintaining solid market structure? Are we buying it as we're making higher lows and higher highs? Are we selling it as we're making lower lows and lower highs? Are we in that proper market trend, market structure? So now we'll get into the chart. So I've got a couple examples here. We're going to start on each time frame, the daily, the 4 hour, the 1 hour, and work our way backwards. So you see here, I have the daily chart up of Euro USD. For the most part, since the beginning of June, you can see the date at the bottom. From the beginning of June through the 21st, we were above the 8 EMA with a quick retest of the 21, but then again got back above that 8, and now we're holding above it. So as we broke above the 8 and the 21 here on the 20th of June, the 21st of June, we would look to the shorter time frames to find if the 4 hour and 1 hour are also telling us that we want to be long biased. Because why? We are above the 8 and the 21, which makes us biased to only wanting to take this long. Here on the 4 hour chart, you can see we are also on the 20th and 21st outside that 8 EMA. You see how price action is above the 8 EMA. So over the course of these 2 days, you're only going to be wanting to trade this long. You see we had a shift candle right here, right, which put us into an upshift. So after that upshift, and as we hold the 8, doesn't matter how many days it is, you want to continue to be long biased until it reclaims the 8 and tells you that it's either in consolidation, as it did here, or that it's going to continue to the downside and break that uptrend. But notice how none of these bars break the 8 EMA, and the trend doesn't end until it does so. Taking it down to the 1 hour chart, still on the same day on June 20th, you can see it was above the 8, above the 8, above the 21, retested the 21 with 1 bar. Like I said, small bar. What happens? Comes back, quickly reclaims that 21 and the 8, holds it all day, so you're holding that long bias. So even here, as it pulled down overnight to the 21, you'd stay long bias, but you wouldn't want to enter it until it got back above the 8. Understand? So if we go down into the time frame on the 5-minute here for our entry, we can see on the 21st at 3 o'clock in the morning, with that long bias, we had an upshift. So you could have entered on the upshift, and very quickly, this ran up 20, 21 pips. You can see. You would have only been risking 11 pips. The stop here is set at that most recent higher low, which again confirms the market structure. So when we see the upshift, you take your entry at the close of this 5-minute candle, the stop goes at the bottom of that structure, and you ride it for 2 to 1. Here, you almost got 2 to 1 a couple of times. It pinned up, and it ends up actually pulling back down. And as you can see, it throws a shift candle down. But the uptrend is so strong. What does it do? It quickly, again, within an hour, throws another shift up. So if you didn't take this early entry because maybe you were sleeping, you could potentially take this entry here at 6:15, 6:30 in the morning and hold that all day long. And you can see this goes about 40 pips, 38 pips by the end of the day. So here, where would your stop have been? Right under the most recent higher low, because here was our low set. This was our new higher low. So you would have entered here, and your stop would have gone right underneath these candles. And notice, even in this pullback, it's one candle it breaks, comes right back above. One candle it breaks, comes right back above. So you never want to just jump out of trades when you have the 4-hour, 1-hour, and daily time frames all telling you the same direction. Here's another example. Same day, a little bit later in the morning. Sometimes this will happen where you see shifts up, but it doesn't move. You see how it kind of comes up and just chops sideways for a little bit, and then it actually ends up shifting down. Notice how it never breaks below market structure, which was that most recent higher low here. So if you had taken this first entry, because I like to read it left to right. I don't like to just look at it over here and be like, oh, that's where I would have gotten in, because that's just hindsight. Left to right, this could have induced you because that's a shift candle up. So your stop would have been, and if you had held in the trade, it was only 13 or 14 pips on the stop, you could have made 50 pips by the end of the day. If you had pulled the trade when it shifted down and it held under the 21 and the 8 EMA, you have to be willing to get back in the trade long when it shifts back up in the direction of your trend. Because what happens here? It shifts up, pulls back, retests that entry price, and then ends up moving higher as the day goes on. So what do? You hold the trade, hold the trade, hold the trade, and you let it do what it's going to do based on the higher time frame analysis. Let's go into another example here. This is Euro NZD on the daily chart. Again, we start on the daily and work our way down. You can see over the last 6 days or so, since we shifted down, you see the 8 and 21 cross, we now are in a downtrend. We're short biased here on the daily time frame for the last 6 days. Take it to the 4-hour. You can see over those 6 days, it is beautiful, just holding the 8, holding the 8. It doesn't even touch the 21 EMA with a body. So what are you doing? Only looking to short this thing. Here, on the 1-hour time frame, you can see all day here, outside the 8, outside the 8, outside the 8. So you're looking for shorts because it's going to keep moving lower, more likely than it is to turn up and go higher. Here on the 5-minute at 7:40 in the morning, you get a really nice roll down, and I actually measured this a little bit lower if you would have waited for this strong bar. Let's say you didn't like that shift candle because it was a little small, a little weak, whatever it is. You wait. You can always wait, and you can still make money. So here, what happens? You enter. Your stop is about 17 pips above your entry price because of why? The most recent lower high, because you're selling it, which is right here. That's where the stop is. This pulls back, and what does it do? Breaks the 21 with one candle, comes right back down. Tries to break again, back down, and rides that trend down 25, 26 pips, 2-to-1 almost, before 10 a.m. So within 2 hours, you're already at almost 2-to-1, and you just got to set it, forget it, and let it do what it's going to do. You can watch this trade. If this had broken here on the 21, and then this candle next had been bullish and came up closer to the stop, pull it. Instead of getting out at 17 pips on the stop, you'll get out at 12. You'll save yourself 5 pips if 2 or more break. But if 1 breaks and you're committed to holding for that break, you got to stay in the trade, because look what happens here. As the day goes on, it holds the 8 EMA, holds the 8 EMA. And that original entry now, by 10 o'clock in the morning, would have been up over 50 pips. You're almost at 3R. If you really were patient and you really just read the chart, look how it never breaks the 8 EMA even until noon. So if you took the trade at 7:40, you followed the rules, your stop loss was 17 pips, and you held this thing all the way until it got slowed down here till noon. If you held it till noon, you're talking about 4-to-1 risk reward, meaning you risk 10, you're making 40. You risk 100, you're making 400. You risk 1,000, you're making 4,000 on a trade like this. Here we have another example. This is GBP AUD on the daily time frame. Again, we're outside the 8 EMA over the last 5 days since the downshift here on the 24th to the 25th of the month. Previous to that, for about a week and a half, it was consolidating around the 1.84, 1.83 zone here at the 21 EMA. But if you look back a little bit further to the beginning of June, the end of May, you can see it was actually in a downtrend for majority of that time period for about 3 weeks. So knowing that you were in a downtrend beforehand, now seeing the downshift here, you want to, again, just confirm to yourself, okay, we're moving back into that overall downtrend. If you look at the 4-hour chart, you're going to see the same thing here. From the 24th, 25th, 26th, 27th, and 28th, that entire week we were outside the 8 EMA. So every single day, you're just looking to trade it short, according to the daily and now the 4-hour. If you take it to the 1-hour and we look at the 24th, 25th, and 26th, you can see, like I said already, majority of that time we've been outside the 8 EMA. Here at about 6 a.m., we ended up shifting back down after a brief pullback, but as you can see, that one kind of fake out bar just retested the previous zone before it moved back down into that overall trend. Like I said in the notes here, the highest probability trades are going to come when all time frames confirm the direction. So we now had the daily, the 4-hour, and here the 1-hour telling us that we should be short biased. So if we take it to the 5-minute, here early in the morning on the 25th at about 4 a.m., you can see we get our first downshift. Now, I do have markups here to show you just the shift candles in general. I personally trade from about 6 a.m. to 10 a.m. New York time, but because Forex is a 24-hour market, these trades present at all different times of the day on different pairs. And I know that some of you are not in the United States. I know some of you are coming in from all over the world. So please understand that these are New York times, but for some of you, you might be wide awake. I'm sleeping still at 4 o'clock, but some of you might be up and on the charts, and that's why I wanted to show you these examples across multiple periods of time, multiple times of day. So again, on the 5-minute, we have our downshift here, shift candle down. You can see it does pull back through the 21 for 2 candles, but then quickly returns back. So once we see that return underneath, if you did pull the trade, you could potentially use that as a re-entry signal. That's one of those 3-candle reversal formations. It still is in the downshift, and that's important. That tells us that overall, we're still going to move lower. It might be slow, but we still are going to move lower. And you can see it kind of drops, slows down a bit here from about 5:30 to 7 a.m., and then at 7 a.m., you see a 2-candle formation off the 21 EMA, and then a shove down for the next 2 hours to 9 a.m. This is 89 pips here, only risking about 40. The reason the stop was up here because that was your most recent lower high. Again, we're in that downtrend, so we're looking for lower highs. So here, your stop is 40 pips, which means you're looking to get about 80 out of this. You're going to have to trust the GA, which is a pair that does have a lot of volume right now, but you're going to have to trust that it can reach that full 90 pips, 80 pips, and it does. It exceeds that actually. So here, this was at 4 a.m. And again, if you take that shift, you hold it until it gives you the exit signal. If you take the exit here on the 2-candle break of the 21, you could use a re-entry signal here once it reclaims and doesn't shift up, or wait and you'll find an even better entry here a couple hours later off the 21 EMA as well. So there's 2 solid entry formations here, the shift candle and this 2-candle formation. I would use this 3-candle if you did pull the trade and wanted to get back in. But other than that, I'd look at the shift and I would look at the 2-candle formation right here. Here is another example. This is CAD JPY. This is a slower pair compared to GBP AUD, but this is a little bit more recent of an example to when I made the course. You can see this is on the 27th, 28th, 29th. These are, just the last 3 days of trading. We've now been moved into an upshift. It's now shifted back up, so we're going to be long biased according to the daily from the 27th, the 28th, and the 29th. That bar here on the 26th is what set that upshift. That's where the 8 and the 21 EMA crossed. So now, looking forward, you're saying, okay, where's the 4-hour chart? Well, here, the 4-hour chart, since that upshift, was holding the 8 EMA every single day from when it shifted up. That was right in here on the 26th, the 27th, 28th. You can see we held the 8, held the 21. So again, confirming the long bias. Here on the hour chart, a little bit choppier, but again, from my notes, you can read, as long as we hold the 21, we still have to be long biased. Now, that doesn't mean we're going to enter a trade if it's, for example, between the 8 and the 21. We might want to wait to see if it gets back above the 8, but I'm not going to change my bias if we're still above or holding on the 21 EMA in an upshift. You see, we're in an upshift because the 8 is above the 21. In a downshift, the 8 will be below the 21, okay? So here, the 27th, we're looking for longs still. Now, if we go to 2:20 in the morning, you can see this was a 5-minute shift candle up. You can see the 8 and 21 EMAs cross here at about 2:20 in the morning, and it moves about 5 pips higher before kind of chopping its way around, and actually would have stopped you out here at a 5-pip stop. So you could have got 1-to-1 out of this trade. But the reason I wanted to show this to you is because not every trade is going to be a winner. And this goes back to what I said first about this pair when we were looking at the daily time frame. It's a slower pair. Compare it to GBP pairs, compare it to Euro pairs. CAD JPY isn't going to move the same way. Now, over time, in 5 years, in a year, in 6 months, I don't know which pairs will be moving the most and which pairs will be moving the least. But right now, the example that you need to take, the lesson you need to take from this example is that you have to use this beginner strategy on pairs that move a lot. You want pairs that are covering 80, 90, 100, 150 pips on an average day. Not a pair that's going 40. Not a pair that's going less than 40. Anything like that, it's not going to be a volatile pair. It's not going to pay you the way you want to get paid. Now here, it gets a little bit more interesting because if you hold the long bias on CAD JPY, we move into the next day, we look at the 28th. This is right after midnight. You can see there is another upshift, and what does it do? Chops its way for a few minutes before shifting back down. So again, still being choppy, but if you hold that long bias and you used that original stop you would have taken here, right after midnight, the stop would have been at the most recent high or low. at about 10 pips from the entry point, that stop never would have been hit, and you could have made 2-1. This went 20 pips by about 9 o'clock in the morning. Now, it takes a ton of time, and you can see it is choppy. It does come down, pull you negative, then move you into profit. Come back down, pull you negative, and then move you into profit. So there's a couple ways to handle this situation, and the thing that I would say is you always want to look at it left to right first, so you're not, giving it the hindsight bias that a lot of people tend to do. So we see the upshift here. If you had pulled the trade as it shifted down, you would want to be able, logically, to re-enter when it shifts back up. So that's another reason why we talk about risk management. I'm only risking 0.5% here, because if I get back in, I only have to risk another 0.5%. And now even on the day so far between both positions, I've only risked 1%. Not a big deal to me. I'm very willing to risk that. And here, that trade moves into profit before what? Shifting back down, coming back to break even, and chopping its way around. So let's say you ended up really trading it poorly. You pulled the first trade, lost 3 pips, whatever it is, 5 pips. Shift back up, you get back in. You don't make any money on this one. You end up out at break even. Now you're down 5 pips between both positions because you were out negative on the first one and out at break even on the second one. When it represents right here, you can see as we move to the right, almost at about 7:30 in the morning, there is a shift up. That shift up ends up moving you into a profit. So when you're using this beginner entry strategy, the best way to do it is find volatile pairs, find the ones that are confirmed on all time frames in the most clear trend, all saying to buy it, all saying to sell it, and then trading that direction as much as you can with the best possible entry signals that you can find. For example, if you look at these shift candles, this is a solid shift candle where the entry price is right off the bottom of the 21. This is an interesting shift candle where the entry price here is below the 21. Here, again, off the 21. So little things like that will play into the probabilities of your trade. But the point is, trade small and stay consistent with your direction. Do not go long, then hop in short, then go long, then hop in short. If the 4-hour, the 1-hour, and the daily all tell you long, you trade it long until you lose at least 3 trades. If you lose 3 trades, the pair might be choppy and you want to move on to the next one. But I think if you stick to volatile pairs like the GBP pairs, here we're going to talk about GBP JPY. You stick to volatile pairs like the Euro pair, the people are actually trading where the money actually is being turned over, you're going to find movers. You're going to find solid trades. And this is a great example you're looking at in front of you here. This is GBP JPY. You can see from May 2nd, this thing has been outside the 8 EMA. It literally, just now in July, finally is touching the 21 EMA for the first time in 2 months. So, very clearly on the daily time frame, we are short biased. Take it to the 4-hour, and you can see here, from the 11th, when we had our shift down, kind of took a few hours here, it shifted, and then took a few hours for the EMAs to cross. That set us in a downtrend from the 13th through the 14th, over the weekend, into the 17th, into the 18th, and then by the 19th, it finally had kind of corrected its trend. But over the course of the 12th, 13th, 14th, 17th, and 18th, so you're talking Wednesday, Thursday, Friday, Monday, Tuesday, you were short biased, very much so short biased. Now, we're short biased on the daily, short biased there on the 4-hour, so what do we see on the 1-hour? We see our downshift here, right before noon, probably around 10, 11 in the morning, and from there you can see how well for 2 days into the weekend, Thursday and Friday, it moved lower. Here on the 17th, it moves even lower. So you can see those trends are now all confirmed from the daily, the 4-hour, and the 1-hour. If we take it down to the 5-minute, here, this is a little bit before midnight, you can see our first down shift. It's about 9:20 in the evening. It shifts down. That open price is right off the 21 EMA, and the stop is going to go right here at that most recent lower high. That's about 13 pips away. What happens? It moves down. It retests the 21 here, retests it, breaks it, and comes right back down. Breaks it with one candle, comes right back down. Remember that rule. So here, from your entry price at 138.00, we'll call it, this drops to about 137.90. So you sneak out about 10 pips right there within the first few minutes. However, it does pull back, shift back up, kind of, retest the entry price, and then comes right back down. So what happens? Well, let's say you pull the trade. You're out with a couple pips of profit or at about break even. You stay with the direction. It shifts down right here. You get back in, and that one takes you down into profit for about 20 pips. And that's where the move is that you want to be involved in. So either you hold that original entry or you get out and get back in. You want to close these trades blue. So if it starts to slow down, if it starts to break the 21, no. Hey, look, I'm going to pull this trade. You should know it's fine to get out of the trade and wait for the better entry. Now here, on the 13th, you can see, we see another 5-minute cross down. So again, moving into the next day, right here, we're talking on the 11th, moving to the 12th, moving into the 13th, that downtrend continues. This is a little bit later. This not at 9 p.m., this is at 2:40 in the morning. So again, right when the London session is getting started. So these GBP pairs, you know that they might have some gas in them because that market is waking up. We talked about the trading sessions already, the times of day, right? So here, like I said in the notes, 2 days later, you get the 2-candle reversal. It's a shift candle down with the 8 and 21 cross, and you're able to break that trend line, that ascending trend line, which is even, another confirmation that you're going to see a movement to the downside. Now, could you predict that it's going to fall 33 pips, as I haven't measured here? No. But your risk was 10 with your stop at the most recent lower high, and you can see 2-to-1 here, 20 pips was easily reached. It just beautifully holds the 8 EMA. 2-to-1 was no problem. Here, again, on the 1-hour chart, I want to show you that entry comes in this strong bar off the 8 EMA. And notice, it shifted down the day before, creating the short bias, confirming the short bias, so you're only looking to take it short. And when you're coming off the 8 there, that's a great entry signal for us. So here, let's move into the 14th again. Into the next day, we don't even have it touch the 21 EMA. So here, what happens? 2:30 in the morning, it shifts down, and look, test the 8, doesn't break it. Test the 21, doesn't break it. Test the 21 again, doesn't break it. This is a 10-pip risk, and it falls 57 pips, 5-to-1. So very easily, that 2-to-1 risk-reward ratio that we always look to get out of these trades, very easily that was reached for you in this trade by 5 o'clock in the morning. So you wake up, you set the trade, you move on, you look for other entries, you see what else the market is doing, and here your take profit would have been smashed. Notice, this is a beautiful 3-candle reversal formation. That right leg is lower off the 21 in a downshift. Here, another 3-candle reversal formation, right? That's dead even, but it's a really nice formation off the 21. And what happens? Instant push, instant shove down. So just take note that once you're in the downshift, you will typically see at some point a retest of the 21 EMA. And you want to watch it to see, is it going to retest and hold and push off for a formation, either a 2-candle or 3-candle formation like you see here, or is it going to break and continue higher? Do I want to be out of this trade? Here on the 14th, moving same day, just moving a little bit later, this is at 9:35 in the morning. You get the downshift through the 21 and the 8. You're short biased. Again, there's an ascending trend line you can see right here. Small little triangle formation, right? That triangle formation is broken to the downside. And what does it do? Throws a couple pins, but it never closes a 5-minute body through the 8 or the 21. Never. All the way down until it finally breaks the 21 and then continues higher. But 2-to-1 take profit was smashed. You're risking 13 here, right? 29 pips was reached, so well over 2-to-1. Very, very simple here. And again, if you're watching the trade, if you're staring at it, sitting there watching it, read the EMAs. Don't be like, oh my God, it's slowing down. I got to get out of this trade. Look at the dojis. Look at the hammers. Look at the dojis. Don't react that way. Watch the 8 EMA, see where the candles close, and that is going to tell you how to make your trading decisions going forward. So I have 2 more examples that I want to go over in this beginner entry and exit signal chapter. Before I go forward, please make sure that you understand with this analysis, remember it is top down. We start on the daily, we move to the 4-hour, then the 1-hour, we find our entries then on the 5-minute if the trend is confirmed on those higher time frames. With the risk management here, your stop is going to go when you're selling it at the most recent lower high. And if you're buying it, the stop is going to go at the most recent higher low. The risk that you're going to want to put on to these trades is never more than 1%. Very often, I'll do 0.25% of my overall account balance or 0.5% because, as I've already showed you, sometimes you do need to cut these trades at break even. Sometimes you got to get out of them for a small loss. But if you stick with them, these are the trends that paint for weeks and weeks and weeks. So once you find that trend, if you can stick with it, you're going to eventually find the entry signal that's going to put 2, 3, 4, 5 risk, 5R, 5 risk reward, 5-to-1 in your pocket. You've seen it already. So let me show you 2 more examples. This is GBP NZD, again, another GBP pair because these pairs move really well with this strategy because they have volume, because they've got the volatility right now. With Brexit going on and more traders getting involved, wanting to trade the pound because of that macroeconomic climate that we're living in, this is presenting great opportunities for us. So here on the daily time frame, similar to the other GBP pairs we've looked at, from May into June, it was very much in a downtrend. Slight pullback at the end of June to the 21 EMA. Couldn't even hold it for more than 1 candle. You can see breaks it with a bullish candle, comes right back down and holds underneath it after that point. Once we push off here, and this kind of looks like a 4-candle reversal formation off the 21, doesn't it? After the downshift here. So once we push off that 21, you have to assume we're short biased. So for the last, I would say 7 days or so, we've been clearly short biased. You take that to the 4-hour chart. You can see coming out of those 7 days, we are clearly outside the 8 EMA. But from the first, second, and the third of the month, you can see it was a small retest of the 21 EMA until we finally extended off from the second going into the third. Notice it never breaks the 21, so you're still short biased here. If it had broken the 21, that can waver the short bias, but because it's holding the 21, you want to still stay short biased. And again, here on the hourly chart, you can look from the second into the third, it shifts down and beautifully holds that 8 EMA. So once this downshift happens, and this is, again, GBP NZD, so this is a pair that's open for the New Zealand and Tokyo markets because of the NZD, and this is a pair that's open in the New York and Euro session because of the GBP. So it's a very popular pair. It's got a lot of volume to it. So overnight, it continues to drop and hold that downtrend, so we are looking for shorts. And here at 4:15 in the morning, again, if I go back to the hour chart, you can see from 3, 4, 5, 6, even 7, 8, 9 in the morning, we're outside the 8 EMA. So I'm good to go to short it. The daily said I could short it. The 4-hour says I can short it. The hour says we can short it. So I'm looking for shorts. Here, 4:15 in the morning, stop at most recent lower high, right? Shift candle down off the 21. It's a nice looking entry. Stop's only 12 pips. That's solid, right? I'm only looking for 24 out of this thing. And what happens? It drops, holds the 8, falls about 25 pips, pulls back, breaks the 21 with 2 candles, but then quickly returns. If you had just held through because it didn't shift up, you see how that 8 never crossed the 21? If you had just waited to see if it shifted up, waited to see if 3 candles broke, you would have then had to pull the trade. But if you did wait, and you were able to stay in, you can see this gives you 32 pips before it actually ends up coming higher, shifting up, and retesting that original entry. Even after that, though, what does it do? It shifts back down and moves lower. 50 pips from the original entry here. And why is that? You're going to be like, Austin, how is it this easy? Why is it making this much sense? Because you're reading EMAs. If it breaks the EMAs, and the reason we only have 2 is what keeps it simple. That's why we are able to find these trends so easily, because you're only looking at the 8 and the 21. But when you can line up all of the time frames telling you to trade in the same direction, very rarely are you going to be wrong. You're just going to be early sometimes. And you'll hear me say that a lot as we go into the next chapter and we talk about the advanced signals and some of the ideas that we find there. Very, very often, if you read these indicators the right way, are you going to be wrong in identifying trend? More often than not, you're going to be early. And if you can stay disciplined, cut your losers fast, and wait for the proper entry, you're going to be able to make money, like I was saying earlier, 2, 3, 4R on a lot of your trades here. So let's just say we took this trade short and we ended up pulling the trade as it shifted up here. We took a couple pips, 15 pips out of it. So we're up 15 pips on the day. You risked 1%. So you're doing good. You're feeling good, right? Even at 15 pips, that's over 1R because you were only risking 12. When it shifts back down here and that candle comes off the 21 EMA right here with that body off the 21, you can re-enter the trade short and ride it down until it gives you an exit signal saying it's going to come higher. So when it shifts down, the stop at that point would have been here at the most recent lower high. Look at the lower highs as the trend is moving down left to right across your screen. Lower high, lower high, lower high, lower lows too. And that's the sign that we are in a downtrend. So when you take the shift, the stop goes at the most recent lower high. Now, our last example, this is more recent. Again, this is GBP AUD. We talked about these GBP pairs. You know they're moving. So here, the downshift is clear at the end of June going into July on the daily time frame. So you know by now. You see that 8 and 21 cross. You see the 8 is below the 21, which I already told you means what? We're short biased. Take it to the 4-hour. July 2nd, July 3rd. Beautifully holding the 8 and 21 EMA. Beautiful, right? Clearly, again, telling me to short it. The 1-hour. Look at that. It doesn't even touch the 21. Not even a pin. It doesn't even touch it. So clearly, again, short biased. And if we look at the third, again, the entire day on the third, you are outside the 8 EMA on the hour. So if we look at the third on the 5-minute, what do you find? 4 o'clock in the morning, it's a beautiful shift candle down. After being in a downshift for a long period of time, it shifts up, tries to go higher. It can't. Shifts back down. That's your entry. Stop at the most recent lower high, so about 17 pips, and this ends up falling 70 pips and never touches the 21 EMA. So when you find volatile pairs, you will very often see moves like this. How do you take advantage of all 70? In my opinion, you never will know exactly where the bottom is, right? Never. It's very, very difficult. Sometimes you'll get it, and I literally the other day, we had a GBP NZD trade 2 days ago, and I got out at a great time. It happened to be the bottom before it reversed. I didn't know it was the bottom. It reached my take profit levels, and that's why I was out of the trade. So here, when you talk about risking 17, if I can go in and get 20, I'll be pretty happy. If I can go get 40, I'm going to be really happy. If I'm going to get 50, I'm going to probably be full out of the trade at that point by 50. I'm over 2R, maybe I leave a little bit on and I manage by moving my stop loss down. Because once you're in a profitable trade, you can move the stop loss into profit. That way, if it does spike up, you can lock those gains and make sure you don't lose any money. So again here, you want to read the chart, but you also want to stick to your rules. You want to stick to, hey, I'm going for 2R. By the time I get to 2R in profit, 2 to 1, I'm taking half of the trade off and I'm locking the stop loss at break even, so I cannot lose any money. My biggest thing, guys, is that people will bounce strategies and be greedy. They'll be consistent Monday to Thursday. They'll screw it up on a Friday. You got to be disciplined. It is a business. This is not a gamble. This is not a game. No matter what anyone tells you, oh, I think it's like a video game. No, it's not. This is the largest financial market in the world. You got to take it seriously. So if you move into profit, lock the freaking gains. The more you win, the more your account will grow. It might not grow as fast as some of the people that don't do that and try to, take huge swings and their drawdown is 45%. But you don't want that. You don't want 45% of your account to go into drawdown, right? You want 4%, 5% at most. So lock the gains, move the stop loss down, and manage the trades as they develop. So here you can see if we go into the same trade a little bit later in the day, this is at 9:30 in the morning, it actually shifts down again after, again, trying to pull back up, trying to shift back up. But we know the uptrend is weak. The daily, the 4-hour, and the 1-hour all tell us the uptrend is weak. So when it tries to shift back up, we don't buy it. We don't go long. We wait for it to shift back down. And if it looks like a good downshift, we take the trade. This isn't a good downshift. You see, that almost looks like your shift bar, but the 8 and the 21 don't cross until way later, 2-3 candles later, and those candle bodies aren't off the 21. So what do? You don't trade it. Just freaking wait. If it's actually going to be a good move, you will find a better entry. What happens? 20 minutes later, by 9:30 in the morning, that is a 2-candle formation off the 21 EMA. It never even touches the 21 again, except with this one pin. It holds the 8 and drops 55 pips from that entry. Your stop would have been right here at the most recent lower high, and you would have been looking for 2 to 1. So you would have been only going for 40 pips here, 45 pips, and it goes 55. So more than enough again later in the day. So even if you were up at 4 o'clock, boom, you made 70 potentially, maybe you made 40, 50 here, whatever it is. Again, stay with the pair. Why are you going to just walk off? These are the volatile hours between London and New York. Until 12 o'clock noon, New York time, there is volatility in the market from 1 a.m. New York time to 12 noon. That is the most traded time period across the entire world. Okay? So when you are trading, if you can find the direction, stick with it. Here's another great entry. This puts 40 more pips. You make 100 pips potentially off this pair in one day off 2 positions. And at most, you are risking 40. I mean, risk 40 to make 100, I would do that every day. You know what I mean? So let's summarize the beginner entry and exit signals one more time for you. Remember, you want to do top-down analysis from the daily to the 4-hour to the 1-hour. If the trend is confirming itself on all of those time frames, if there's confluence between the time frames, what are you going to have? Confidence in your trade, right? So once you have that confidence, that confluence, you move from the daily through the 4-hour, through the 1-hour to the 5-minute to find the entry signal. The 5-minute is where you'll set your stop and where you'll set your take profit. You want to stick to high volatility pairs because you want something that moves, and you only want to enter on the candle formations that we spoke about earlier, the shift candles and the 2 and 3 candle formations for your entries. Remember, breaks of the EMAs are your exit, and 2R is the take profit on most of these trades. Now, talking about that just a little bit deeper, if you hit 2R, or if you're getting close to 2R, you can move the take profit lower. Give it space. If it's holding the 8 EMA, give it space. Move your stop loss, though, so you cannot lose. I don't want to ever see someone move a take profit lower or higher if they're buying or selling it, whatever it is. Let's say you're selling it. I don't want you to move it lower, but not move your stop to guarantee you're winning something, right? Because you never know what's going to happen between news, tweets, this and that across the entire world. This market reacts in a second. You need to make sure you're locking gains once you find profitable trades. Because remember, these are not going to present every day. Some days you might look through and be like, you know what? There's nothing here. And that's perfectly fine. Because when you do find good trades, you've seen from the examples now, you're going to see 3R, you're going to see 4R, you're going to see 5R, and very, very often you're going to be able to get 2R out of these trades. So if you have any questions, please drop a comment below. Send me an email. Let me know if any of this doesn't make sense. And if you have any markups, you want me to analyze your markups, you can always email me, reach out to me in any way that you can, and I'd be more than happy to check those out. So now that we've covered the beginner entry and exit signals, let's move into Chapter 7, really where we're going to go into hundreds of markups here on our advanced entry and exit system.